I'm going to give just a 10-minute macro update and overall update on our positioning across our Crescat funds. We're going to turn it over to Tavi then to give a more in-depth macro update, and then as usual we'll have Quentin come on in the last hour to talk about our activist metals strategy and positions. And so let's get started. As you know, we're extremely bearish when it comes to the overall stock market, and especially the valuations for the S&P 500 for large cap technology stocks. It's no secret to anyone who's listened to our calls for some time, but we have some new data here that is now showing from Ned Davis Research that household stock allocation is at an all-time high. That stocks as a percentage of all financial assets among households and personal trusts. And why is this important? Because this is truly an all-time high in the history of this data. And we're concerned about valuations. We're concerned about positioning and sentiment, as well as market, other technical market breadth information that in combination, when you look at all these things combined, along with the other macro indicators, we believe we are in the vicinity of a major stock market top, and it is highly risky to be long the S&P 500, to be long, the Magnificent Seven, popular tech stocks at a time. I know they've been working recently, and there's some strong momentum, but we think there are extraordinary risks at this time to this positioning. Let's go on to the next. This is just showing that in the last 4 weeks, we had the largest inflow into technology stocks. Basically in the history of this data here, the largest tech fund inflows. So again, momentum, sentiment, at the same time as we have record high valuations. This is just not a good combination. We want to be contrarian to this type of data. Let's go on to the next. This is something that Apollo did, and they're looking at valuations 12-month forward on a PE basis for the largest 10 stocks in the S&P 500, and then they look at the rest of the S&P 500, and then they look at the valuations 12-month forward PE on the rest of the stocks. There's one period in here that might look like it was higher in 2020, but that's somewhat of an outlier period that they pulled the data from, because we had just had the COVID, the brief COVID recession that really made earnings look unusually low. So we don't want to look at PEs in the middle of a recession. That's not appropriate, to do. But if we look at PEs at the fullness of a business cycle, at PE ratios when profit margins are near all-time highs, and then we look at the PEs, what we see is the profit that the PEs that we have right now for the top 10 largest stocks on a forward-looking 12-month basis are the highest they have ever been in the middle of an expansion cycle, and higher than the tech bubble in 2000. The PEs for the top 10 stocks forward PE higher than 2000, and the highest that they've been in the history of this data here. Just another valuation chart showing the excessive valuations at what we believe is near the peak of a business cycle. Let's go on to the next. Positioning. So now we're looking at the BofA Fund Managers Survey, which shows that money managers, fund managers, are near historic underweight in cash. So by questioning them as to what percentage they're overweight in cash, you see they're at some of the most uh, at the least overweight cash that they've been in the history of this data, going back to 2005. The only other time was when they were on margin in 2021, ahead of that market crash in 2022, when they were even more underweight cash. And you can also see that on looking at the lower panel here in this chart, that the percentage of cash relative to AUM among fund managers is below that 2 standard deviation level, and only 4% of overall fund assets are in cash right now. These are similar levels to what we had ahead of the global financial crisis in 2008. Let's go on to the next. John Hussman. This guy is a Stanford PhD economist, really smart guy. He manages money. Yes, he's been a bear for a long time, but that's because we've been in record valuation territory for a long time. And for him and his fixed income strategy, that's normally an indicator for him that he wants, he'd rather be in cash and fixed income than in the stock market. And that strategy, works fine for him over time. For us, his data is extremely compelling valuation data for the stock market. And this is his own proprietary measure. It's kind of like a Warren Buffett index, where Warren Buffett looks at stock market, valuation relative to GDP. He's looking at relative to GVA, or gross value added, which is similar to GDP. Let's just say that. And what it shows is that we are at the highest valuations ever on this benchmark, similar levels to both 1929 and ahead of that market correction that we had at the end of 2021 and over the course of 2022. Basically a double top in this valuation metric relative to the beginning of 2022 and relative to 1929. Let's go on to the next. So one thing that the John Hussman has started doing is looking at a combination of other technical factors, if you will, market, including this one indicator that looks at the narrowing of the market. So when you have New York Stock Exchange stocks that are at new 52-week lows, and comparing that to stocks that are at 52-week highs, and what we've seen is there's just been a narrower and narrower group of stocks hitting new 52-week highs at the same time as there's a broader and broader number of stocks hitting new 52-week lows. And so the breadth of the market has been deteriorating. And this is he also looks at another sentiment indicator here, which is we like this type of a contrary view, using market sentiment. And when investors' intelligence advisory bearish is less than 30%, this is something that he's noticing, he's taking note of here. And so these red bars are other times when you've had the S&P 500 at a new 5-year high, at the same time as you've had this narrowing of breadth where 52-week lows are greater than new 52-week highs, and at the same time as you have investors' intelligence, advisor bearishness. So it's an intelligence survey of investment advisors, and where there are very few bears, i.e., less than 30%. These are the three instances on this chart. So, people will talk about Hussman, being so hung up on valuation and that's all that he cares about. No, you'll notice nothing in this chart is about valuation at all. This is 100% technicals. S&P's at 5-year highs, breadth narrowing, investors' intelligence, bullish sentiment, bearish sentiment rather, extremely low. Guess what? Those are the other 3 times that we signaled this. One was ahead of Volmageddon in that Volmageddon period, 2018, 2019. One was the peak of the tech bubble in 2000, and one was at the end of 2022, right ahead of that market correction in 2022, and the other is today at the same time as other charts showed that record valuation. These are things that we have showed in our own research as well. We're just showing you that we're not the only people who only smart people. We like to think we're smart. This guy's a smart guy, Stanford PhD economist. He's showing this stuff too. We think it's worthy of taking note. Let's go on to my last slide. So this is looking at the this is courtesy of Oliver Gross off of Twitter. I've shown a similar chart before. This is looking at the Canadian Venture Index on the TSX Venture Index. The top panel there is the index price performance. You can see been through like a almost 20-year bear market basically in this thing. It's insane. But you can also see in the lower panel the volume, the record low volume that we've had over the last 2 years. So here we are, consider all those other prior 6 charts that I just showed you. Now juxtapose those with this one here. We have record highs in the S&P 500, record momentum, record valuations, and at the same time, we have this other entire industry, and this Canadian Venture Index is a proxy for the junior mining industry, the exploration focused segment of the mining industry, and we have something that has been through a multi-decade bear market and is extraordinarily undervalued. That's a whole nother segment that we could go into, and we have gone into at length in our prior videos. It's what we've been positioning for the last 4 years, to build a portfolio of extremely undervalued explorers and an activist strategy, getting them the money to do the drilling, to create the new discoveries that the world needs. If we're going to have modern civilizations, especially an AI-driven civilization with technology, we need metals. This is the index of where most of the exploration focused mining companies are listed on the TSX Venture Exchange. We own many of them there, and we have a portfolio of 70 plus different companies, many of them listed on this exchange. 60% of them have bona fide discoveries, thanks in large part to the money that we've helped to provide them to do the drilling to create these discoveries. But here we're showing how undervalued this entire segment, how overlooked it is. At the same time, juxtapose it with those other 6 charts of how overvalued, overcrowded the rest of the market is today, especially this technology-driven, large-cap, Magnificent Seven market. We still believe strongly that there is a rotation coming and a potentially very serious market correction out of this overvalued large cap, mega cap tech. It's driven by the fundamentals. It is driven by the fundamentals, the valuations, and the impossibility of sustaining the growth rates and the spending that that the companies at large are spending on AI infrastructure right now. There is the return on capital is just not there for this investment at this time. There's been an over indulgence in the spending. These are the things that make major market tops. We think we are in the vicinity of one, ahead of this rotation into this undervalued commodity metals industry in the stagflationary time.